Okay, so in this section, right, it's about entry trigger. So let's do a quick recap. What you've learned so far. So far you've learned about market structure. It tells you what to do. Should you be looking for buying opportunities, selling opportunities, or to stay out of the markets? Then we covered about area of value. There are two things we covered in area of value: support, resistance, and moving average. And these are tools that you can use, right, to tell you, where to buy or sell. So market structure tells you what to do. Area of value tells you where to buy or sell. And now we're moving to the third component, entry trigger. This tells you when to buy or sell. Okay, so entry trigger, there are many ways you can use. There are many tools out there to help you time the market, but what I find personally to be very useful is candlestick patterns. And I want to dive deeper into this section since I find it so useful. So what is candlestick patterns? So candlestick patterns is a method of reading a price chart. Of course, it's not the only way. You have bar chart, you have line chart, you have all the different types of chart out there. So candlestick pattern is just one of the methods to read a price chart, and it's also one of the more popular approaches. So how do you actually read a candlestick pattern? One thing to understand is that there is 4 data points for every candlestick pattern. You have the opening price, the closing price, and the high and low of the session. So if your candlestick pattern is, let's say, on a 1 hour time frame, then what you'll see is that the highest price point over the last 1 hour, and the low is the lowest price point over the past 1 hour. So a little bit more about candlestick patterns is that you can use it to trade different time frames. So for example, if you see a candlestick pattern on the 1 hour time frame, it simply means that on a 1 hour time frame, every 1 hour a new candle is formed. If it's on a 4 hour time frame, every new candle is formed every 4 hours. And if you're on a daily time frame, one candle is formed every single day. Same for the weekly, monthly, same concept. So now let me explain, how do you actually read a candlestick pattern. So you'll see primarily 2 types of candlestick pattern. One is green and one is red. But let's talk about the green one first. So remember I said that there are 4 data points. So how do you actually know where are the 4 data points? So very simple. For a green candle, it simply means, right, that the price has closed above, right, the opening price. So let's say this is like a 1 hour candle. Okay, let's say this is a 1 hour candle. So what it tells you that the price, right, has closed, right, higher than where it was 1 hour ago. So that's why it's green, right? It has closed higher, compared to where it was at the opening price 1 hour ago. So that's why it's green. So the opening price will be at here, and the closing price will be here. This is the only way for the closing price to be above the opening price. The closing price has to be higher than it. So that's why it's green, it's bullish. So the opening price, once again, is over here, this line. And over here is the closing price. We'll add in some numbers later on so you can see how it all makes sense. So what about here? This simply means it's the highest price point over the last 1 hour if you're on the 1 hour time frame. And this is the lowest price the market has went, right, during the past 1 hour. Right? This is the lowest price point. So this is the highest price point over the past 1 hour, and the lowest price point over the past 1 hour. Of course, if we change this to a different time frame, to the 8 hour time frame, the daily time frame, concept is the same. So let's say we try the weekly time frame. Let's ignore the 1 hour, the weekly time frame. So what does it mean? It means that at this price point of the candle, that is the highest price point, right, over the week, over the past 1 week. And this is the lowest price point over the past 1 week, over here. And this is the opening price of the week, and this is the closing price of the week. So same concept. So now what about red candle? So this is just the inverse. So if you recall, this over here was the closing, and this is the opening. So the closing price is higher than the opening price. That's why it's bullish, that's why it's green. But for a red candle, it simply means that the closing price is below the opening price. I repeat, right? The closing price is below the opening price for a red bearish candle. So your closing price has to be here. See? And over here is your opening price. That's the only way, right, for this candle to close lower, is if the closing price is below the opening price. And likewise over here is the highs, and this is the lows. Exactly the same concept. So if I want to piece all this together, you will have a chart that looks like this. Okay, this is what I just said earlier. So a little bit more so-called technical definition if you want. So we call this color thing the body, and this line over here, we call this the upper wick or upper shadow, whichever whichever term that you prefer. There's no right or wrong over here. And this is what we call the lower wick or lower shadow. Okay, so this is how you read a candlestick pattern. Now moving on, let me share with you how it looks like, right, on a real chart and how you interpret it. So I'm going to look at this currency pair. Let's look at the daily time frame. This is Aussie against the Japanese yen. I'm going to zoom in so you can see so we are on the same page. So you can see over here, I want you to pay attention to these numbers over here, right? This is the opening price. This is the highest price point over the last 1 day. This is the lowest price point over the past 1 day, and this is the closing price, and this is the percentage change, right, in pips. So this number will move, right, depending where my mouse cursor is, so pay attention. So let's look at the most recent one, this candle here. How do we interpret this? So let's interpret this together one by one. So for this candle, It tells you that this market opened at 83,589. So it opened at this price point, 83,589. The highest price point for the day is 83.788, which is over here, 83.788. The low of the day is 83.036, which is here. The low of the day, 83.036. And the closing price for this market for this day is 83.529, which is at this price point over here. Does it make sense? So let's do one more example. How about the dollar against the Japanese yen? Okay, now we have a green candle. So same thing, right? For this market, the opening price, what does it say? 109.248. This is the opening price, 109.248. Where is the highest price point for the day? 109.96. 109.96. Where is the lowest price point for the day? 109.193. Over here, 109.193. And where is the closing price for the day? 109.614. 109.614. And along the way, you will probably see some candles where they are missing a body. Man, that candle is weird, Rainer, where's the body? So this is usually when your opening and closing price are too near one another, where you get almost a non-existent body candle like this one here. Look at this, right? Almost a non-existent body. So yeah, it happens especially when the opening price and the closing price are very near each other. So if you have a look at this, right? Let me just see what the numbers are so you don't freak out. So for this candle, the opening price for this is 103.76, and the closing price is 103.75. Okay, so this is why you can see they are just like a 3 pipette difference, 0.3 pips difference. So that's why their body is almost non-existent. So this is how you actually read a Japanese candlestick chart. So moving on, right? So now you know the basics, right? How do you actually, or rather, how do you use it to time your entry? So to do that, right, you want to focus, right, or learn a few patterns, right, to help you do so. And there are 2 patterns, or maybe 4 patterns that I want to share with you. So first, let's talk about the bullish reversal candlestick pattern and understand, what is it, how it works, and the story behind it. So the first pattern that I want to share with you is what we call a hammer. So different candlestick patterns, they have different names. They have hammer, harami, engulfing, dark cloud cover and stuff like that. So there's really a lot out there. But I'm not going to teach you everything because it's not needed, right? As you progress and learn and grow as a trader, you realize that, hey, most of these patterns are pretty much a variation of one another. So I'm going to share with you the most common variations, the most useful ones, and after which you can go on and explore the other, patterns out there. And of course, the basics I've already taught you, so you can just, stack upon what you've learned and to learn even more. So first one is what I call, or not I call it, people, others out there, the technicians, I call it a hammer. So let's understand what hammer is about. So again, where is the opening price? Price open over here. Where is the closing price? For green candle, the closing price has to be above the opening price. So it's here. Where is the high of the day? Over here. So let's assume that this is the daily candle, right? The high of the day is here, and the low of the day is over here. So what's the story of this hammer? So it's quite interesting, right? You can imagine that when the market opened over here, the sellers, they were in control, like out of the gate, right? They're like barbarians, running out of the gates, and they pushed the market, they pushed the price down near the lows of the day. Then when all the buyers, they're all defeated, right? Then somehow or other, there's like one Captain America from the middle of nowhere shouted, Avengers assemble! And then they all unite and, push the price up all the way up higher, finally closing near the highs of the day. So you can imagine that this kind of tug of war between the buyers and sellers, right? When market open, sellers came in, smash and, push the price all the way down. Suddenly, sometimes in the middle of the day, the buyers, they woke up, right? They assemble, they unite, and they push the market all the way up to close near the highs of the day. So this tells you that, hey, the buyers are now in control. That's why they managed to push the price, right? Push the price all the way near the highs of the day. And this is what we call a hammer because it kind of looks like a hammer. Okay, so another pattern that's worth learning is what we call a bullish engulfing pattern. So the story is very similar, but this time around, it's expressed, right, using 2 candles. So for this one over here, this is a red bearish candle. So you can see that the sellers to control and close the price right near the lows of the day. So the buyers were all defeated, injured, really painful. The next day, right, somehow the buyers, they got revived, right? They grew stronger, right? Maybe they put, a little bit too much steroids in their body or whatsoever, take some magic potion, and they push the price, right, to close near the highs of the day once again. So they pretty much has overwhelmed, right, the selling pressure of the previous day. How do I know that? Because you can see that the range of the candle or the range of the body over here was previously from this opening price to this closing price. But the next day, it opened low and closed even higher than the previous day opening price. So you can see that the buyers has even overwhelmed, right, the sellers, right, by even a little bit more. So this is what we call a bullish engulfing pattern. So next one, the opposite of bullish candlestick patterns, right? This is what we call the bearish reversal candlestick pattern. So there are 2 as well. This one is called a shooting star. So this is actually the inverse of a hammer. I'll just explain the story behind this. So since it's a red color candle, opening price is here, closing price is here. So what happened, right? So you can see that when the day started, right, let's say this is a daily candle, buyers push the price all the way up this higher and mark this highs for the day. And then suddenly, the sellers came in, and, took control and pushed the price near the lows of the day, finally closing near the lows of the day. So the buyers were, when the market just opened, really excited, woohoo, let's push the price up higher. Then somehow, middle of the day, things got depressed, maybe, he got reminded of his ex-girlfriend item, his ex-sweater, let me throw this sweater, let me sell everything. And then the market collapsed and sold off and nearly pretty much closed near the lows of the day. So you can see that initially, buyers, they had the upper hand, but they were overwhelmed by the sellers, right, towards the end of the day. So this is where you get a shooting star. So for this bearish engulfing pattern, right, it's pretty much similar story. So we can see for the first candle, it is bullish, right? Buyers were happy, woohoo, I celebrate, right? They've closed near the highs of the day. But for the second day, right, the sellers took control and pushed the price right all the way down lower, exceeding even below the lows of the previous day and even the opening price of the previous day. They closed near the lows over here. So you can see that the buyers once again, they were defeated. Injured, hospitalized, and they'll never. I don't want to say never to recover, because in the market it always goes up, goes down. So for now, I would say the sellers has temporarily won the war. Okay, for now. So let me share with you a few charts, right? So you know how this looks like on the chart, and you can see that all the different variations of it out there. So let me point out to you the first one. Let's have a look at how about dollar against the Japanese yen. So you can see over here, this one looks something like a in between a shooting star and a bearish engulfing pattern. Then we have this one as well, more of a shooting star. If you look at other example like euro against the USD, you can see over here, this is similar to shooting star, but the difference is the body of the candle is green. So again, when you trade the markets, right, it doesn't mean that it has to be a text. For example, it has to be red color. Sometimes it can be green as well, but the meaning is pretty much the same, because if you look at this, right, this is the price rejection that you have seen, right? The buyers tried to push the price up higher, but got overwhelmed by the sellers and finally closed, right, near the lows, near the opening price of the day. Over here, you have a bearish engulfing pattern, right? Look at how this range of the candle has, overcome, right, the body of the previous day. And this is a bullish engulfing pattern. Notice how the body of this candle has, is larger, right, and close, right, even above the highs and the opening price of the previous day. This is a bullish engulfing pattern. And then this is another bearish engulfing pattern. And yeah, so later we'll look at some chart examples, in terms of the market structure, area of value, entry trigger, and stuff like that. But for now, let's do a quick recap. So I know I've covered a lot. So number one, remember, market structure, it tells you what to do. Should you be looking for buying opportunities, selling opportunities, or to stay out of the markets? Then we have area of value, which tells you where to enter a trade, where. And finally, the thing that we just covered, entry trigger, tells you when to enter a trade. And by the way, if you're enjoying this training so far, smash the thumbs up button. If you are not, then hit subscribe and then smash the thumbs up button.